HMRC are making it hard for entrepreneurs to innovate, grow and scale successful, profitable businesses. So they're making it tough, but not impossible.
Let's talk about tax, right? Could you run through a couple of tax traps that a lot of entrepreneurs fall into when they start trying to take money out the company?
So
who should be reaching out to you for help?
Anyone who has got traction in a business and has started to pay tax and it's started to become a pain point for them. Gary Stevenson, I imagine most people have watched the Diary of a CEO podcast. Gary Stevenson's message on that podcast, he didn't know the difference between inheritance income and actual trading income, which for a start is not great for someone who's a data trader and should know everything about the argument that he's putting forward. That's one point. Two,
what's some advice you can give around scaling a team?
What would you say is the most tax efficient way for a director to pay himself out of a company?
What is a director's loan account? Because I think a lot of people probably don't even know what that is. What makes you different to your traditional high street accountant? So Josh, what makes you different to your traditional high street accountant?
So when I started like 5 years ago, I looked at the typical accountant, and that embodies traditional business cards, posters, leaflets, quite an old mentality. They don't understand marketing, they don't understand digital businesses, and they don't really understand the typical entrepreneur. They are just good at numbers, spreadsheets and data entry, whereas I was different. I was looking at it from more of an entrepreneur's vision. Like I would have been successful in no matter what I did. It was just that I chose accountancy because at that point in time, I looked at what skills I had. It was good at numbers, analytical, and I picked the highest paying skill with them specific skill sets, which was accountancy. So I came at the accountancy industry from more of an entrepreneurial viewpoint, which meant that I grew it like a digital business. I understood how to scale teams, pick the right people, put them in the right seats, and also speak to an entrepreneur like an entrepreneur. And that allowed me to grow my business pretty quickly and do a pretty good job of it.
Yeah, for sure. You've definitely done a good job. So we've done, you've probably heard like an elevator pitch, for example, and accountancies are one of those professionals where typically if someone says, what do you do? You say an accountant. For a lot of people, their brain probably instantly shuts off. So where you're trying to target that more entrepreneurial client, what would be your elevator pitch when someone asks you, what do you do? How do you typically try and draw people in so that when they first meet you, they know you're different?
So just simply that we have a track record of doing it for hundreds of businesses to help them build profitable, scalable, tax-efficient businesses. We don't just do accountancy and data entry. We don't take on clients for just accountancy. We're going to be advising that business owner how to grow, scale, increase enterprise value, and look to build a long-term business that's profitable, scalable, and tax efficient.
So we were talking about this before the cameras were rolling, right? You're the first of your kind to take to social media with huge virality. Anyone in business in the UK has probably heard of you. What gave you the idea to take to social media in an industry that's just so kind of, I don't know, black and white, you know?
So when you're going in an industry and it's competitive, you've got to try and do something that your competitors aren't doing. And accountants aren't on social media speaking reels, quick, digestible, solving problems in 60 seconds. So for me, it was easy. What are accountants doing? How are they marketing? Well, they're on LinkedIn, or they're doing paper, old school methods of marketing that's 20 years old that may work for the event industry but doesn't work for accountants or service-based businesses. So I just did the opposite. No one was on Instagram, no one was on social media. So I took to that and just put the reps in, got a little bit better each time I had a round of filming, started getting traction and built the business off the back of it.
Where were you getting inspiration from? Obviously not accountants, sorry.
So always looking at what clients were asking, because that was a real life problem that a client's asking. So my team still actively to this day, any problems that clients are asking or questions that they're asking internally in the business, that gets sent to me. We then turn that into a content idea. I then solve it with a nice hook at the start and as quick as I can, in a nice digestible format, and then that usually...
What's the most common question you're getting?
Common question. I mean, it's usually just how do we save tax? I mean, that's a pretty common question. How do I write this off? How do I set up a structure to be more efficient? Quite a lot.
Have you read the book, what's it called? They Ask You Answer?
No.
Oh, it's a good marketing book. Read it. You're already actually implementing all of the stuff they teach anyway, but it's a good book nonetheless.
when I bumped into you, I think it was at one of Aaron Branch's events. How long ago was that? Maybe 2 years, I want to say? 2 years ago.
Maybe.
And I remember speaking with you at the time. I think your waiting list was like 700 people waiting to work with you.
Yeah.
When did you have a moment and realise that you were blowing up and this was really going somewhere? Like, how many inquiries were you getting, you know, on a weekly, monthly basis at the height of what you're doing?
So I was on about 4,000 followers, and I was in Florence. So we'd just gone away for mine and my partner's anniversary. It was like a 4-day trip, supposed to be no work, no phone, just chilling out. And one of our clips went viral. We got, I don't know, maybe 1.5 million views.
Wow.
On Instagram, which that doesn't usually happen on Instagram. So we was getting maybe 100 leads a day for quite a short period of time. And then that slowly went to 70, 60, 50, 40, 30, and then sort of leveled out at maybe 10, 15, 20 a day. And I was like pacing up and down on an anniversary trip, voice notes, trying to like make the most of all these leads that we were getting. And at that point in time, I maybe had 7 staff. So I didn't have the back end systems or the team or the capability to fulfill that level of workload. So it just ended up piling up a waiting list. So we had that much demand. Daniel Priestley talks about this, like supply and demand and the imbalance. So our demand has always been up here, and our supply has always been trying to meet that demand. Whereas most people are the other way around. They've got the supply, but they're trying to chase leads for demand. We've always been the other way around. So our business issues or the bottlenecks we've had has always been, how do we scale up a team that can deliver a happy customer as quick as the leads are coming in? And we still haven't figured that out to this day, although we've scaled pretty quickly.
So the biggest entrepreneurs that I know of in the UK prefer you. From what I understand, people want to work with you, right? So what's the vetting process like with all of the inquiries you have? Like, for somebody to work with you, what type of criteria do they have to meet?
When you say me, do you mean me personally or the team?
You and the team, or maybe you personally as well, actually. It'd be good to kind of understand the balance.
Yeah, I don't do much direct work anymore. I may do some consultative calls. If I'm getting involved, it's usually 8-figure business. If it's the team and they're working with us for like general accountancy and tax advisory, we usually start sort of 500k turnover upwards. But the typical client is usually 1 million onwards, because our packages are more, we don't just do like the compliance services, we do compliance, but we also give you a business management pack. So we'll show you your P&Ls, we'll show you your KPIs, we'll show you your metrics. And then we've also got packages where you add on a strategic advisor, and that strategic advisor will have almost your monthly board meeting with you, set targets, sets goals, and actually support you to whatever you're trying to achieve, whether that's scale to exit, increase enterprise value, build a team out, incentivize them to a certain goal, whatever that may be.
With your personal brand, right? So you're going viral pretty much every single week, I could imagine, maybe sooner or more often. Do you have a problem where, like, a lot of the inquiries that come through, they want to work with you directly? And if so, how do you kind of manage that?
I think when your leads are driven by a personal brand, it's personal, right? It's you. So you're always going to get that element of, I want to speak to the guy that's on Instagram and the guy that's behind the social media account. You just have to set the expectation very quickly on them calls that you won't be speaking to Josh. You have to be untouchable and out of reach, or the level of validation that you have because of the brand that you've built automatically declines, because they're then straight on a call with you and it's quite easy. There isn't much barrier to access. Like, you wouldn't go and book in with Alex Hormozy and expect to speak to Alex Hormozy. And I know that your brand needs to be at that level in order to be on the same page as Alex Hormozy, right? But you can't just get straight on a call, or they're not going to respect and validate your brand as much. So you've just got to set that expectation really on it's the team, it's Thomas & Co. And you've got to try and shine a light on your business rather than you.
Makes a lot of sense, for sure. A question I've got around social media as well is, where do you feel like you would be if you never took to social media?
If I didn't take to social media, I was gaining traction anyway, but through referrals, corporate partnerships, through putting the legwork in, social media catapulted growth, because it meant that demand went up very quickly. So then it was scaling the business up in order to meet the demand. Whereas if we was to flip that around and say social media didn't blow up, it would have been steady demand increase, steady supply increase. So it would have been the same linear curve of growth to get to where we are, but over a much longer time horizon. So social media just meant that I had to sort my shit out quicker.
Quick pause from the podcast to give a special shout out to one of our sponsors, the Rejuvenation Doctors. The Rejuvenation Doctors is a hair transplant clinic in the northwest of England in Bury, owned by Dr. Jamie. Now, I can personally vouch for these guys, as I myself around 2 months ago had a hair transplant from Dr. Jamie, and I can't wait to see the growth in the next 3 to 6 months. The service was amazing. It was very VIP. He looked after me throughout, and he made a very uncomfortable experience extremely comfortable and caring. Now, boys, if your hairline's going back, if you're receding, if you've got that McDonald's hairline, do not wait until it's too late. Message Dr. Jamie today at the Rejuvenation Doctors. His tags are in the link to the description of this podcast, and he will sort out your hairline just the same as he's sorting out mine.
You see like the proper nuts and bolts of most businesses, right? So like, what are the most common problems you're seeing that people are struggling with when they're trying to scale?
So most businesses are trying to scale to an unreasonable target for the business vehicle and model that they're in. So you have to review the business vehicle you're in and see if that's the least amount of friction and barriers way to get to the goal that you're trying to get to. Because if you've got a poor business model with low margins, high client churn, it's not efficient to acquire customers, you've got a lot of competition, you haven't got a moat around your business, AI or technology may come in and replace you, you've not got an efficient business model to try and scale to 8 figures. So it's unreasonable for you to think you can get to 8 figures. So sometimes you've got to pivot and change your business model.
What are some of the best business models you're seeing right now, or best industries to be involved in right now?
So ones with leverage, ones where you can leverage team, code, capital, and you can scale quickly and acquire a customer quite cheap. Customer acquisition is one of the biggest costs, especially of like e-commerce brands or any like marketing agencies. You're churning, right? You've got two clients come in, but you've got 2 clients come out because there's competition and there's someone promising a better deal somewhere else. So you need to find a business where you can retain your income and retain the customer. That has, if it's e-commerce, it needs to be high average order value. It needs to be returning customers, so something that they're going to come back to and repeat, being a repeat customer. If it's more of a service-based business, then it needs to be returning. It needs to be recurring revenue, ideally.
What's some of the business models? Because I think, especially now in 2025, we see so many gurus online on Instagram promoting this business model, rent to rent this, rent to rent HMO in property, or drop ship this and become a millionaire, etc., etc. What's some of the models that behind the scenes you actually see aren't that profitable or aren't overall successful?
Rent to rent is one of them.
We've been there.
Yeah, I mean, turnover is sky high, but profits are
it's correct.
almost non-existent.
Yeah.
I see that with a lot of businesses, like drop shipping.
Yeah.
That's a perfect example.
Yeah.
Drop shipping, you get like 2% profit margins. So a lot of these businesses will come in and acquire to us, and we look at the revenue metric. It's like, I'm doing 20 million, but they get on the call and they don't have cash flow. They don't have any money in the bank at all, because it's either stuck in inventory, so they can't actually have what's called an efficient cash flow cycle. So if you're investing in product, you want to be able to sell through really quickly, release that cash to reinvest and continue to grow with momentum, which you can't really do that in a drop shipping business. So it's looking at a business model with high margin, efficient customer acquisition, a good cash flow cycle, no moat, and relatively low competition. Also something where you can look 5-10 moves ahead and see if there's going to be any shifts in that specific industry because of technology, because of AI, or the way the world's going, is that still going to be a need? Trying to forecast forward, like Patrick Bet-David, he's got a book on this, Think 5 Moves Ahead. Think as many moves ahead as you can, because a lot of people make decisions based on tomorrow, next week, next month. Really poor thing to do. You've got to think as far ahead as you can, forecast forward, and then reverse engineer the steps back from that.
Sure. What would be a couple industries specifically? Give some examples that you're seeing that are successful right now.
I mean, any agencies that are targeting AI, software businesses, SaaS is huge. The enterprise value on SaaS companies, you can be losing money and still be worth millions in terms of enterprise value. So you want to go for something that's got, depends what your goal is. If it's to cash flow, live a fancy lifestyle, then you want a high cash flow business. So something that's got quick income, you can release the income quite quickly in terms of service delivery. But if you want something with like true enterprise value long term that you can then exit in the future, you need something with assets. You need something with IP that you own. You need to own an asset that sits on the balance sheet that has high worth that you can then sell or leverage, license it to other businesses.
Have you taken any opportunities or been offered? I'm sure you perhaps have been offered opportunities to come on board some of the businesses or get some equity.
Yeah, I mean, that's one of the beautiful things about what we do. We see into businesses all day, every day. Yeah. And I think that's one of the reasons where I would say I've progressed quite quickly and scaled quite quickly, because I've always been inquisitive. So if I'm working with an e-com founder and they're doing really well on email, I ask how they're doing well on email, what strategies they use. If I see something not going so well, what did you do? What was your strategy? Okay. And every time it's a lesson and a learning, but not from a book or not from a podcast. It's from real life, which, you know, is always true to the fact, because what you see on social media sometimes isn't true.
So give us your full rundown of like, what is your marketing playbook? What's your strategy that you use?
I look at real life problems with clients and then I solve them on social media in quick format, short form, where business owners can understand it very quickly. Take that and then straight away be inquisitive to, why is my accountant not doing that? Why is my tax advisor not told me that? That then poses a question. And then when that question's met with, oh yeah, we can do that, or friction, then that causes them to question why they're with that accountant and not with us. Smart. Then that causes them to...
It happens so much where like people are just forwarding your clips to the accountant.
Yeah, they literally do. They literally do. So then straight away it's like, well, if he's telling me all the answers and I'm paying my accountant and I'm getting more for free than I am for a retainer, then let's go to Josh's business.
Why do you think there is so many accountants that actually aren't that knowledgeable on a lot of strategies and tax saving strategies?
So accountants aren't knowledgeable on tax saving because most accountants were just number crunchers. They're just data entry. If you go and do accountancy exams, it's all theory, it's not practical. So you're not actually doing complex tax scenario and planning issues when you're in college or when you're going to university. You're just doing theory-based data entry. So accountants don't know how to apply it in the real world and actually in businesses. And they also don't have communication skills to be able to communicate that in a way that a general business owner understands.
So where do you learn and continue to learn from yourself? Is it through courses? Is it through exams? Or is it...
Just practical experience, yeah. I did sort of 5 years in other practices and just rose the ranks, got a lot of like real world experience working with businesses, set up on my own. And then 4 or 5 years later, we've got a team of over 40. So I don't do much directly anymore. I get fed the information from the team. I produce the content and then I work on the consulting business. But it's just learning from practical, real situations rather than what the study book tells you.
Something I struggled with, and I'm sure lots of other business owners and people listening to this probably also struggle with when scaling, and especially if trying to scale pretty fast, is growing the team and putting senior staff members or management staff members in place. Yeah, where you pay a good wage, you need to put trust in them, but it's then having the understanding of like, how do you keep an eye on what they're doing without completely micromanaging? So what's some advice you can give around scaling a team at a pretty fast rate?
So a few steps to this. Scaling a team is firstly got to start with recruitment. You've got to have really strong recruitment methods in place where you're really doing everything you can to make sure that person is a fit for the business and it's got the skill set that it says on their CV. Because a CV can be fabricated, it can be typed up by...
ChatGPT, mate.
Exactly, exactly. So try not to work with anyone until you've worked with them. So always do some form of test project. So if we're getting a business owner coming to us for a tax advisory role, we will give them a model client portfolio that's like an example, and we'll say, right, what would you do with this scenario? How would you save them tax? How would you make them efficient? How would you change the structure? They would then fire us a report back with everything they would do. So we've then got a practical, real-world example that they know what they're talking about and they can apply it to a client. So first is... don't work with them until you work with them. Do a test project. Second is incentivize them correctly, because most people just do salary. Like the most efficient format of having a team member perform at a high level is commission only. But not every role can be commission only because you can't directly attribute every hour to revenue. but always have some form of incentive package in place for any staff member, whether that's commission-based, performance bonus, tracking KPIs, and then having certain incremental gains as they hit them KPIs. So you've got to incentivize them right. You've also got to put right people in the right seats. Don't have people doing roles that they're not good at. If they've got to communicate heavily, then your recruitment process should have been heavily looking at communication skills, not just the tax advisory part. So also pair the right people to the right seats. And next from there, I would say...
What about some of the KPIs that you put in place to in order for you to track how they're performing, so you have a clear view?
Yeah, so I'm just trying to string back to your question. So your question, so when you said, how do you keep an eye on what they're doing? You shouldn't keep an eye on what they're doing, because that's almost micromanagement. You should have a dashboard that shows you all the KPIs that they're specifically responsible for, and you should track the dashboard. So for me, I've got over 40 staff. I can't know what every one of them 40 staff are doing. I've maybe not even spoke to or met 10. So I've got to rely on data to tell me, are they performing at the level they need to? And data is going to allow you to not have to micromanage and put your finger in every pie. So have a dashboard that's linked to your CRMs, linked to your payment processes, linked to your social accounts, and then whatever that person is specifically responsible for in their role, try and have a live flow of data in order to track that, and then have an amber light system. So let's say that you know they need to be performing at X metric percentage, that's green. If they're slightly below, it's amber, that's something they need to work on. And if it's below that, then it's critical, it's red, that's something that needs to be addressed with an appraisal or an immediate meeting with a team member.
That makes a lot of sense. Thanks for sharing that. So let's talk about tax, right? So we're all entrepreneurs in here, and we all do like fairly well. And I know a lot of people listening to this will be at a kind of stage in their business where they are generating perhaps more profit than they have done before.
Okay.
Could you run through a couple of tax traps that a lot of entrepreneurs fall into when they start trying to take money out the company?
So the first one is no real forecasting of what they're going to need, when they're going to need it. You should forecast your take from the business, your drawdowns, as long as you possibly can. And life does change, revenue changes, so sometimes you're going to need to take stuff out that was unexpected. But you need to try and forecast forward as accurately as you can. And also make sure your accountant isn't then just using dates as the determination for the dividends that they then vote on your tax returns, because you can choose the timing of your dividends. Example being, let's say you take 20k tomorrow, doesn't have to be a dividend, that can sit on your director's loan account that can then be voted at a time in the future. So try and, one, forecast forward how much you take, and then two, understand when do you vote dividends to try and time the tax years to be in the basic rate band as much as you possibly can without going into higher rate. And it's also looking at what you can add onto your package or offset through the business to not increase that personal take home, which then increases the amount that you're going to be paying higher rate on.
That makes sense. And just whilst we're on that as well, right, what would you say is the most tax efficient way for a director to pay himself out of a company?
So it's going to be a basic salary. You want to take your director salary, pretty much most business owners will know that, $1,047.50 a month. Mm-hmm. That's going to be tax deductible in the limited company, presuming you've got a limited company, and tax-free personal to yourself. Then the remaining $37,700 would then be taken via a dividend, which is taxed at 8.75%. Total is about $4,189 a month.
What does that compare next to PAYE if somebody was to earn the same money perhaps in a job?
Massively different, because you've got employers' national insurance, you've got income tax at 20%, so your take home would probably be maybe 30%, 40% higher. But you've then got to consider, to understand the full picture, you're going to pay corporation tax on them dividends before you pull it out of the company. So it's not a complete fair comparison.
I heard something on social media, I can't remember exactly how it's structured, but there's a way an entrepreneur can fall into like a 60% tax thing. Could you just run through how that happens and also how to avoid it if you need to take more out of a company than 47k a year?
So 62% tax trap is in the bracket of income between 100,000 and 125,140. And when you get in that bracket, you have what's called abatement of personal allowance. So for every £2 you earn, you lose £1 of your personal allowance.
Wow. Which
means that you're already paying higher rate tax at 40%, assuming income tax. You're already paying national insurance, which drops to 2% at that point. So you're at 42% there. But now because you're losing your personal allowance, you add on another 20%. So you're at 62% taxes in that range. And in order to reduce the 62% tax trap, you would have to find other means of distributing to yourself. And if you absolutely need that income, then you'll have to salary sacrifice, you'll have to increase your package via company vehicles, you'll have to offset mileage, wear and tear of personal assets, or pay yourself via an overseas entity, or keep the money within a holdco, pass funds up to a holdco and then focus on investing into tax efficient investments. Or you can go down EIS investments, SEIS investments. You could invest into venture capital trusts, which are all tax efficient government-backed schemes to give you tax relief.
So if let me go over, reel off a few things that we've all thought about ourselves, and I'm sure business owners all have themselves, and just tell me yes, no, or if it is yes, how you can potentially write this off in a limited company, right? So if I said holidays or travel, can you write that off within a limited company?
You want me to give you a yes, no, or do you want me to explain it?
Explain if it's a yes, explain how.
So if it's a holiday, holiday is usually a term for personal enjoyment. So if you're deeming it a holiday, you've lost the battle already. But if it's a trip that's for work purposes and you're going filming overseas because you're filming 5 podcasts and the whole purpose of your trip is specifically to film them 5 podcasts, then any incidental enjoyment that you have is fine. It's still going to be wholly and exclusively for the purpose of the trade. Nice. But if you're going away for 10 days and you film 1 podcast in between that, then that's a no because it's not wholly and exclusive.
So if we do go for the full podcast, but then we also obviously, and we film 5 podcasts in 5 days, but we also go to the beach club, we also go to the steak restaurant, we're also on the beers at night, that can all be a write-off?
So the beers can't. So let's say you go for 5 days and you film 5 days of podcasts. Mm-hmm. You would be allowed a day after and a day before to one, get there, travel, reset, set up, and you'd be allowed a day after to get ready to travel home, pack up, etc. But anything longer than that, if you extended the trip further than that, and it was a 10-day trip and just 5 days in between that were podcasts, then that's no longer wholly and exclusive. So you would then have to start partially deducting some expenses, and some would be written off completely because you have duality of purpose.
So
then
you can do some.
But if you're going wholly and exclusively for a meeting, let's say with a big investor, and that meeting's 2 hours, but you're there for 12 hours, what you do in them other 2 hours, you're going to have to do something. So if part of that is going out and eating, then that's fine.
Okay.
How would it work if you were in a business where there was quite a lot of like client entertainment? So you're going on a lot of like business meals, etc. How would that work?
So client entertaining is tax deductible expense, but gets added back on your corporation tax return. So you don't actually get tax relief on it. However, you don't have to spend that money personally and take it out of the business and then pay personal tax on it. So in summary, you can spend via the company on client entertaining, but it's not allowable for tax relief. You just save personal tax on it.
Right.
Supplies for an office, so perhaps like Huel shakes or...
Just asking for a friend.
Or potentially like meal prep.
Yeah. So
definitely asking for a friend.
Yeah, so like lunches and stuff within the office, if you're ordering in coffees, whatever, that sort of stuff.
So again, it's got to be wholly and exclusive. So if you are letting people into the premises, and as part of them coming into the premises, you need to provide them with refreshments in order to make sure that they are happy in the establishment, then of course you can provide them with refreshments, and that's wholly and exclusively for the purpose of the trade, because that customer coming in is probably providing you with some of your trade. But if it's meal preps, why is that wholly and exclusive? If it's just because you want to get jacked and you want to look good in your business, then that's a no.
What about clothing or like, buying whatever from the shops, bags, clothes, that sort of thing, shoes?
This episode is also sponsored by our friend Matt Hall at Success School. If you're ready to turn your passion or expertise into a profitable online business, check out Online Business Mastery, an 8-module program with 18 months of live coaching and support. Whether you're launching a course, building a membership, or just want to escape the trial and error trap, this program gives you a step-by-step blueprint you need. Learn more and sign up here.
So claiming clothing is difficult because, again, it's wholly and exclusive or duality of purpose. Even if I buy this suit, I can't write it off unless it's embroidered or it has some form of logo on it. Even though this suit will be for content, for events, it has to be seen to be specifically for that. So if it's protective wear and you're in construction, tick, fine. If you're an actor and you've got to go and buy costumes, fine. But if you're in a service-based business and you want to buy a nice represent outfit because you want to look good in the office, that's a no.
So, and what happened, because there's plenty of people, I'm sure you see this, that do just tap on their business card for everything.
Yep.
Go to the shop, put it on a business, go get a cup of coffee, business, do this, business. What happens come the end of the year when they keep tapping away? Do they just kind of get away with it until HMRC look at it, or are they actually, without knowing, their accountants are probably just putting it on and they are paying tax on that stuff?
Okay, so let's imagine every time you tap your card, your accountant gets a notification. And when he gets that notification, he has two options. One, to put that expense to the balance sheet, or one to put it to the profit and loss. And if it goes to the profit and loss, then it's going to be written off as a tax-deductible expense, most likely. If it goes to the balance sheet, it's because that is usually disallowed and will sit on your director's loan account, which then essentially is the same if you taking that money out and then spending it personally as a dividend. So you've got to make sure you review if it's profit and loss or director's loan account.
What is a director's loan account? Because I think a lot of people probably don't even know what that is.
So director's loan account is a account that your accountant will manage on your accounting software, which is a log of transactions stating whether that transaction means that you owe the company money or the company owes you money. So if you introduce value to the company, say you put £1,000 in the bank, that will increase the balance that the company owes back to you. Yeah. Whereas if you take £1,000 out and it's not written off as a dividend, then that increases the amount that you owe back to the company. So it manages the transactions between the director, the shareholder, and the company.
And how long, if you technically owe the company, i.e. you've tapped on all the bids and now you owe the company £5,000, how long do you have to get that money back into the business?
So it's dependent on your year end. If it goes above £10,000 at any one given time, then it can be treated as a benefit in kind, unless you charge HMRC's official rate of interest, which is quite easy to do. So make sure anyone that does that, if it does go above 10,000, but then it's dependent on your year end, which is the year end of the company specifically. So let's say your year end is 31st of December. You've got until up to the point of your year end and then 9 months and 1 day after your year end to either pay it back or vote it down as a dividend.
And you mentioned to one of the questions a moment ago about a holding company.
Yes.
What is the difference between a holding company and a trading company, and why is a holding company a beneficial structure in the UK?
So trading companies for trade, so income received, expenditure out, profit, pay tax on said profit, and that's essentially how a limited company, trading company operates. As a holding company is specifically for holding, whether that's shares or assets. And when you set up a holding company, you usually form what's called a group structure, which essentially means a group of companies that are interconnected by one shareholder, which is a corporate shareholder, which is the holding company. And once you form a group, you then have all the commercial and tax benefits, as well as some drawbacks of a group structure. I could reel off quite a few of them. It really depends on...
What's some of the setbacks, or the drawdowns, whatever you just said?
Added complexity, added accountancy fees, because you've now got numerous entities that you need to complete submissions for. You cannot invest or take investment in EIS, which is Enterprise Investment Scheme. It's a way of raising capital. Same with SEIS. You also cannot set up what's called an EMI scheme, which is a way to set up a share options program for your employees. So there's a few different things that add limitation, as well as financing. Financing becomes more difficult because it's a complicated structure, and financing companies don't like complicated structures.
I want to ask your opinion on a topic, just a slight diversion of where we are right now, on the UK right now. So I know recently you've moved overseas, right? So do you feel like the UK is still a place you can actually build a successful business and live a prosperous life?
So HMRC are making it hard for entrepreneurs to innovate, grow and scale successful, profitable businesses because we have VAT, corporation tax, personal tax, national insurance, and we have a government who's going to continually increase taxes. So they're making it tough, but not impossible, because you just need to look at the tens of thousands of businesses that are doing it. You can build a successful business in the UK, but you need to make sure you're using the playbook in order to be as tax efficient as you can and set yourself up for success with the right firm, the right advisor. It's not impossible, but it makes it harder if you don't have some form of overseas structure. But for most people, that's not possible.
Yeah, it makes a lot of sense. I definitely agree with that. So I want to talk about the tax system, right? if you could redesign the tax system for the UK, what do you feel would be a fair tax system where, you know, we're still giving back to the government, but we're also a little bit more happy with what we're taking home? Have you ever kind of thought about that? And if so, what do you think a good tax system would be?
So I work quite hard on the current tax system, so I don't think about what could be, because sometimes, I mean, that's not going to be the case. But if I was to look at tax revenues as the government, because their job is to increase tax revenues. That's their revenue, right? If you've got a trading company in your service base, you bring in a client, they pay you. It's the same as HMRC taking tax revenue in. That's the way that they earn income to then expend on public services. So what HMRC, I believe, aren't doing a great job at is attracting people that are earning the highest amounts of revenue, the highest amounts of profits, building and operating the biggest companies. You only have to look at America, all the huge tech companies, they're set up right in America. The amount of tax revenues them companies bring and the amount of people that they employ is incredible. Massive contribution to America's economy. So you need to make it attractive for high net worth individuals and companies that want to innovate, grow, and hire big teams, because that's what they need to innovate and grow. You need to make it attractive for people to come here. And in order to do that, stuff like business asset disposal relief, where you get a reduced rate of capital gains when you sell a business, you shouldn't be touching that. You should be increasing that. You should be making it appealing for a business owner to come here, build, because when they do exit, they get a reduced rate. So when they are in that building phase, then they're not going to be as likely to go overseas because they want to dodge capital gains when they come to sell a business. You're almost just asking them to leave just before they sell, and you get your highest amount of tax revenue. So you need to make it attractive for people on sale and attractive for people in the building stage, which is reduction in corporation tax, reduction on personal tax. But at the same time, you've got to then balance that with, well, what's that going to reduce the tax revenues by? And the way that you try and increase that is by attracting people with a beneficial tax system, which attracts wealth into the company. Now, I haven't run the calculations on that, but you've got to try and balance attraction with a reduction in tax liabilities to make sure it's net positive.
It almost feels like we're kind of doing the opposite of that, because I completely agree with you. We should be attracting wealth into the country so we can grow economically. But then it's interesting because on the other side of this, you also have people, I mean, let's talk about Gary Stevenson, right? He's gone super viral recently, and his message is, let's tax the rich more. What are your thoughts on Gary Stevenson's message?
Gary Stevenson, I imagine most people have watched the Diary of a CEO podcast, where Daniel Priestley was discussing this with him. And Gary Stevenson's message on that podcast, just one starting note, he didn't know the difference between inheritance income and actual trading income, which for a start is not great for someone who's a data trader and should know everything about the argument that he's putting forward. That's one point. Two, his theory is great. He wants to bring in more tax revenues. He wants to redistribute wealth to not the higher class. But in practice, what he's saying doesn't work, because on the podcast he mentioned about taxing the rich 1% above 10 million. Well, Daniel Priestley did quick maths on that and said at the very best case scenario, assuming that they don't leave the country, that'll be 20 billion. Well, that's less than the recent NI cut did in Labour. So it doesn't solve the problem. So the argument that is plastering all over social media, news outlets, on podcasts, he hasn't actually run the numbers on his argument, and it doesn't actually solve the problem that he's trying to solve. So if we're trying to solve that problem, we need to look at something that actually works in practice, not just in theory, sells books and generates views on social media.
Why do you think it's selling so many books? Like, why? And he's gaining a lot of like fans and a lot of people. Like his social presence has gone up a lot.
It's just a controversial topic. Everyone wants to save tax and be anti-government and get, hyped up and, oh yeah, we should pay less tax, the wealthy shouldn't pay enough money. It's a topic that people can jump on, but people are jumping on it without understanding what he's saying and how it works and what the implications of that would be. And he's trying to sell a product that doesn't work.
You know what, it's a shame, because it's part of his message that I actually agree with, right, in terms of trying to get people back on the property ladder and giving day-to-day people a better quality of life, because I feel like that's slowly fading away for the middle class and the working class. But I think his solution to it is all wrong, so it's really tricky. What would you say, right, in terms of like the whole kind of Gary Stevenson message there, if that money was to go back to the government, do you feel like the government having more money is going to solve the problem? Because I personally, I'm not too sure if it would.
So he's trying to redistribute wealth from the wealthy by taxing them more to then pass that money to the government, to then hope that the trickle-down effect of that is that ends up in the working class's pocket and they can start affording things. Cost of living crisis and the average earnings doesn't need to be as far in between because they can tax them less. But it just comes down to the numbers. I'm a tax guy, I'm a numbers guy. Anything that I look at when I'm trying to make a decision, I don't let my ego or emotion or how I feel make the decision for me. I run the model on it, I run the numbers on it, and then I let the data tell me what the decision should be. And Gary Stevenson should be doing the exact same. If he's selling an argument with so much force behind it, he should have run the numbers on his argument if that will actually solve the problem, and he should be able to really paint the picture of how it will solve the problem, why it will solve the problem, and what are the steps in order to achieve it, and he clearly has not done that.
So you mentioned a minute ago about overseas structures. Obviously yourself, you've just been in Dubai.
Yes.
I know you've restructured your business. I think there's a lot of people, we talk about Dubai every single day probably.
Yeah.
Thinking about moving there every day.
There's a lot of people interested in Dubai, either for the lifestyle or for the tax benefits. Obviously a lot of people, a combination of both. What's some of the things people actually need to be aware of or consider if they want to get an overseas structure that's going to benefit them from a tax perspective?
So first is, if you're going to set up a company overseas, you've got to look at what's called management and control, which means that if you've set up a company overseas, just because it's set up there doesn't mean that that's where it's tax resident. If you're then the sole shareholder and you are the business, or you've got a UK office, UK staff, UK warehouses, but you've just set up your company overseas, doesn't mean you can all of a sudden just pay tax in whatever region you've set up in, because management and control says that the company's in the UK. So they have the right to pull that back in and then redistribute tax revenues to the UK itself. So they can backdate that, charge fines, penalties, interest. There's also a lot of legislation on it called CFC, Controlled Foreign Companies. So you need to understand that throughout and make sure that if you are moving overseas, the shareholder usually has to move with the business because you're what's managing and controlling the business. Unless, exception, you may have headquarters overseas or you may have different offices and you visit there to make the key decisions, that's then fine. But you can't just set up a company in Dubai, put your feet up on your couch in the UK and pay Dubai taxes. You've got to relocate, usually.
What about if your office and team is here, but you do move with the company out to Dubai, and you're you are managing it out there, does that still count?
So it depends where the revenue's coming from. You then need to really look at the business model specifically, because if all of your revenue's being generated by the team in the office delivering services, just because you've moved overseas doesn't mean your whole company can move overseas. You then would usually have to have like an operating company in Dubai where you then charge your services as a CEO to the company. Mm-hmm. But it wouldn't necessarily mean that the company all of a sudden just upshifts and moves to Dubai if you don't have any presence in Dubai apart from yourself personally.
Do you think a lot of people are set up wrong? Because
I
get hit with adverts every day saying, we can help you move your company over, but a lot of those, again, it's still, they can move your company and they can help you, but it's going to come on your head if anything goes wrong, right? It's not going to be there.
The thing you need to be careful of with them companies that are putting forward the Dubai pitch is they're based in Dubai and they're only looking at the Dubai side. So their service offering to you is, I will set you up a company in Dubai. That's fine. You can do that. They're not selling a dream there.
Yeah.
What they're not giving you is the UK tax advisory and the compliance advisory of whether all that tax you're going to save is going to be clawed back in years to come. So if you're going to make the move overseas, you need to have someone who understands the full picture, UK and where you're relocating to.
So if let's say, it's easier just to talk in first person, right? So Sam always talks in third person and it's so specific to him when he
no comment if HMRC are watching this.
He's like, say if I had 37,000 in the bank
and £27.
Well, let's say someone had, and it's like, mate, you're just talking about yourself. But
not always. Sometimes I try and actually see where the viewers would want to get info as well.
Yeah. But no, so let's say I moved there, I had a company there, and I was doing work myself, but the revenue, so it was me doing the work, but I was charging people in the UK for some kind of service, and all the money was coming from UK customers, so to speak. Is that fine? Because I'm out there, I'm doing the work, but obviously I'm charging UK customers.
At that point, that would be fine. because you are the business and the business is based in Dubai because you are in Dubai. Whereas if your whole team is responsible for the income and you've got a whole operation and an office in the UK, then that's where the lines blur and you need to look at it more specific.
And you see like the write-off you mentioned earlier for travel and stuff where you can actually split and you might, I don't know, charge 50% as a write-off and 50% was in enjoyment. Is there a similar thing with Dubai in terms of you're set up there? Can you get some benefits? Is there like in a grey area?
So is that if you also have a UK business and a UK team?
Correct.
Yeah, so you could, one option would be to charge your company a service fee. So if you're based overseas and you've now got a Dubai co, you could charge your services as a CEO, or you could go on a market rate salary from the business. So you're paying yourself like an employment salary, but because you're overseas, you wouldn't pay income tax on that employment salary anymore. So you could go on what's called an NT tax code, which is a no tax code. NI you have to pay for the first 12 months usually, and then after that you can also apply to reduce the NI. So salary is one option. Charging like a management fee is another option. But there'll also then potentially be a split. So if some of the income is originating from you overseas, then there could be a split of operations, but it'd need to be commercially justifiable.
What about drawing dividends from a UK company if you're based out in Dubai?
Absolutely fine.
Tax-free?
Yeah.
So you probably see this firsthand.
Providing you're resident overseas, tax resident.
Yeah. Right, that makes sense. Yeah. I mean, you probably see this firsthand, right? Like you're hearing about there's an exodus of millionaires out of the UK going overseas. With your client base, how many people have you first-handedly see over the past, say, 12 months actually leave the UK or are trying to create a plan to leave? Like, how real is this epidemic that we hear about every day?
I would say I've had the conversation, or the team have had the conversation with 20% of the client base, maybe.
Okay. It's not as high as I thought it was going to be.
A lot of people can't because they've got family. They've got households, they've got a full team in an office, or they're reliant on a specific location, or a lot of businesses are still, mileage radius, that's who they target. So a lot of people, the option is off the cards. I'd say if you look at who it's on the cards for, like who would have the option, then that percentage is 70-80%.
Yeah, makes sense.
They're not leaving, but considering it.
Yeah, thinking about
Mine
it.
and Luke's business, right? So we run a marketing company. We don't even really have that many clients even in the UK anymore. We've got a couple in Dubai and a lot in the USA as well. So for us, if we wanted to actually set up in Dubai, what would that process look like? Is it pretty straightforward and easy?
Yeah, so you need to look at first your personal tax residency, because you would need to do what's called the standard residency test, which is testing how many days you can stay, which is based on your automatic ties. So do you have a home in the UK? Do you have a family in the UK? Do you work over X amount of time in the UK? So you need to review your standard residency test and understand the amount of days you can do in the UK. Usually 90 to 120, usually, but it's dependent. Once you've figured that out, obviously you need to make sure you spend less than that in the UK to not be pulled in as a tax resident. Second, you actually set up your company over there, and you would get a visa through your company. And then once you've got your visa, you get your Emirates ID, then you get your tax residency certificate, just to belt and brace things. And then at that point in time, you'd set up your Dubai bank, start trading from Dubai, and then make sure that all operations are set up in Dubai. Everything's commercially justifiable. You've got the stamp, and then you just need to watch your days then where you spend elsewhere.
I know you've recently made the move from the UK as well, right? So what was it for you that made you leave the UK to set up overseas?
So with me, it wasn't actually a tax decision. That was a benefit of it. But my decision to go out of the UK and spend some time working overseas and travelling was something that I've wanted to do ever since I set up my business. And I said to myself, when I get in the position that I'm not in the day-to-day, I'm working purely on the business and I'm not needed for day-to-day operations, I would go and work overseas. So I got to that point, decided to go and work overseas, and then also figured out that Dubai is quite a nice place to be, and that it would make sense for me to do 90 days a year there, because I then get my tax residency, pay zero personal tax, and it fits in line with my plans to be overseas.
How would you say that's kind of like impacted how you feel day to day, from being in the UK every day to now kind of being almost like, would you say you're a nomad now, like quite nomadic?
I would say so. I'm now travelling and working overseas, so I suppose that's the definition. For me, there's more to life than just sitting behind a laptop, and I want to make sure that I enjoy the building stage as well, and not just hate the building stage, always focusing on the exit and always focusing on what's next. So for me, it's build, but do it from nice environments with nice people, with a solid team around you, solving a real problem, and doing it in a way that is high quality.
Bringing it back just to, let's use Sam and Luke as an example, because I think it's quite fitting to plenty of people as well. So, as they said, most of their clients aren't in the UK now. A lot of their team, most of their team's not in the UK either. Let's say they didn't do the personal tax residency in Dubai. Could they still set up a company out there and get the corporation tax benefits and obviously whatever you can write off through that company, that sort of thing? Could they still get some benefit without living there full time?
So my question would be, why Dubai? Why are you setting up a Dubai company? Because that's what HMRC would ask you. Why have you got operations over in Dubai?
If we were to say we have a couple of Dubai clients, which we do, what then? Is that like a kind of feasible excuse?
I'm going to ask how many, I guess, percentage-wise.
You could get 20 clients in Dubai because you could...
Yeah, we could sign them quick,
You could deliberately do that.
Then what are you going to do with the money in Dubai?
Spend it at beach clubs.
So it's the problem is getting it out of there. So like it's there now.
So
what you can do.
Let's say you tick the box to have a Dubai company and that's all commercially justifiable. Doesn't change the fact that your personal tax residence is in the UK. So even if you go over to Dubai and then spend all that money while you're there, still personal income. So you would still have to pay tax on it in the UK because you're a UK tax resident.
So I know for a fact there's an awful lot of people that are doing that.
Yeah.
What's going to happen to them, do you think?
Huge tax bills.
So with the companies that are just setting up Dubai companies left, right and centre, charging 5, 10, 15 grand for it, they're doing it without care for the client, they're just doing it for the fee. And HMRC have already clocked on to a lot of people that have these overseas entities that aren't really ticking the box for having an overseas entity. And they will slowly build a team out, send brown letters out and start to pull taxes back from people because they'll see it as a revenue source.
There's a lot of people based in the UK that spend a month, a year in Dubai, have a Dubai company.
Yeah,
they figured it
so
out.
Many. I was just going to say,
There's so many.
Of course, won't say any names, but I know a fair few people that actually still live in the UK and they have Dubai companies. And a lot of people actually just assume that you're allowed to do it. Or they're just kind of lying to themselves. I'm not sure to make them feel better. But
they're both.
They kind of told me, I don't know how true this is, but apparently HMRC aren't allowed to investigate because it's overseas. Is that true or is that not true?
Not true.
So are HMRC able to actually get the files from the UAE to kind of find out that you actually do have business ties in the UAE?
Most countries have a double taxation treaty and it's all listed in there in terms of what they provide and what they don't provide. And if HMRC was to investigate someone because they assumed tax avoidance or fraud or whatever level it would be at, if they was to try and find information about you, specifically about companies that you own, they would be able to do so.
It's the maddest thing as well, right? Because me and Luke spoke to a couple of tax advisories in the UAE and we asked them, is this okay? Is this legal if we stay in the UK and just go to Dubai a little bit? They're like, yeah, it's fine, Habibi, come over. You know?
They don't care. They just want the peas.
They're just lying,
the money, yeah.
It would seem.
Yeah.
So that's what.
There is a lot of people going to get.
So many people actually think they're calm though. They generally think they're calm. They're like, oh no, I've got an expert, and because obviously, they're seen as an authority. Accountants are or part of authority, right? They just take it for gospel.
Yeah.
And then don't actually think about the consequences.
There's a lot of people.
Most of these people that are advising aren't accountants.
Okay.
They're just another business owner that just saw a bit of a gap in the market. Quite a lot of people want this.
They're probably making a fortune.
They probably don't even do it. They just have a partner that they then siphon it off to.
That makes more sense.
Pay a tenth of the fee and then charge you for it.
So I've got a question. Because I know there is some sort of boundaries in terms of, let's say I move to Dubai now, tick all the boxes, have my company there, resident there, etc., etc. So tick the boxes, so I'm tax-free or near to. And I draw the money out of my Dubai company to my personal name while I'm out there. How long do I need to stay in Dubai for it to still be tax-free? Because I'm pretty sure if you come back within a year, you still owe some tax, right?
So just so I'm understanding, at that point, are you a Dubai tax resident
Correct.
and not a tax resident in the UK?
Correct. But I've just gone there now. I'm out there. I'm set up. I'm a Dubai resident. I'm only going to spend less than 90 days a year here or whatever. I have my Dubai company and I'm a personal resident there. I take money out of my Dubai company as I make it, as you would here. It's all tax-free if I stay out there for the next however long, 5 years, 10 years. But if, let's say I came back after 1 year or 2 years, are you still liable to pay some tax back?
So if the money is earned while you're overseas, then no. If the money was earned pre you moving overseas and you're drawing down from a UK company, for example, or you sell an asset, avoid capital gains because you're a Dubai tax resident, and then go back to the UK within 5 years, then they can recharge you on that. And that's what's called temporary non-residence.
So would that include me taking dividends from a UK company? Okay, so if I wanted to do that, I'd need to stay out there for 5 years.
Yes.
But any money I made through a trading company while I was out there, even if I was only there for 18 months, 2 years, is still tax-free?
Yes, if it was sourced from Dubai while you was out in Dubai, then the UK won't recharge you on that.
Got you. So speaking specifically property, again, this is just me talking first person, but a lot of people do own property.
Yes.
We own properties in limited companies over here.
Yes.
In the UK. Just talk to me. What can I do if I move to Dubai? Is there anything you can do to relieve tax when trying to sell properties, or within the limited companies over here? Is there anything you can do?
Property is difficult because it's in the UK. It's literally an asset in the UK. So
something you can't move.
Yeah, there's very little wiggle room unless it's a property trading business. If it's an Airbnb and you've got service let, then that's more of an ongoing cash flowing asset with like trading income. But if it's investment purposes, then you're going to struggle unless, let's say you are owning like a portfolio of 15, 20 properties and you're based overseas, you could charge your company a fee for you actually managing them. But again, it would need to be at arm's length and you would need to make sure it's not excessive. You couldn't charge 500 grand a year to manage 20 properties.
But when the property sells and we pay whatever it is, 25% corporation tax on the profits, then at that point, taking it out of the company into Dubai, I wouldn't have any further tax.
No, not really.
It's better than paying whatever, 30... What would you pay taking out a UK company?
33.75 or 39.35.
It's bad, isn't it? It's steep. It's steep.
What you're seeing with like UK companies that they're not doing, like they're missing out on like missing certain things out and paying too much tax on. Like.
So first one for UK companies is they don't have the right structure. They need the right structure in place. Second, they need to pay themselves in the most efficient way. Third, they need to understand what is and what isn't an expense and make sure that's communicated with their accountant, because their accountant isn't necessarily tying their trade and their business to their expenses. They're just seeing it black and white. Oh, it's a holiday, it's overseas travel, that's a no. Whereas if you're in influencer marketing or you're traveling overseas for content purposes, then it's maybe a yeah. So your accountant should understand you and your business to then understand the narrative of the expense if that can be tied to your business. But the main one is having a poor accountant.
If you're if you have children and they do some work for your business, can you pay them, and how does that work?
Yes, you can. They've got to be over 13. And then from 13 to 18 and onwards, there's differing rules on amount of hours, how much you can pay them, and certain rules and legislation that needs to apply. But yes, you can. You could, a child at 13, pay them X amount, and then it's no longer going to be deemed your income as the adult. You could go and pay your kid at 10 if you really wanted to, but it would be deemed your income.
So 13 to 16, how much you reckon you can pay them, like, for the work?
It's tough to say because it's got to be market rate to what they're doing.
Okay.
So it's got to be deemed, let's say they're doing bookkeeping for your business or they're doing some admin work, then it's got to be a market rate based on what the minimum wage is for that specific role based on their age.
So would they pay, and that be, if done correctly, there just wouldn't be any tax on that?
No, because they would have their personal tax-free allowance. So 12,570 would be tax-free.
And national insurance, you have to pay that. How would you have to be?
So national insurance, so they'd pay a little bit, depending on how much they're being paid. There's thresholds where you can then earn a certain amount without paying national insurance, and then over that there is the NI allowance that you can offset against it. So depends on the situation.
Do you think it's a clever thing to do if you've got children?
I would say so. If you want to incentivize your children to not just do chores around the house, but actually get involved, they get some practical experience into working life, and you can get some tax relief for doing so, then
what about, can you put your partner or your children on as shareholders or director if it's your partner within the business without them actually doing any physical work?
So the answer is if you put in, so it's what's called an alphabet share scheme. You can set up a share scheme with A, B shares or C shares or D shares, and each of the shares can have a different class. So some could be non-voting, so they don't have any rights to making decisions, no rights to exit if you used to sell a company, but maybe there's rights to dividends based on certain targets or certain preferences. However, if they're then not involved in the business at all, then what you'd vote them dividends on would be up for question. So you should have some narrative in place that would support that.
And do you advise a lot of your clients to have their partners or children involved within the business?
Yeah, it's an option we look at for everyone. Is there an involvement that your partner or your children can take where you can benefit from tax relief, but also, you know, the business commercially benefits?
Does that get messy if there's ever breakups? Or do you structure
it? Can be, but you would make sure the share that you allow to them is, you can basically pull it back. So you can remove the share. It wouldn't be like an ordinary share that you would pass across unless it's someone that you really, really trust.
Yeah. How many, you said earlier you work with a lot of 8-figure businesses. Mm-hmm. You said you work with some, like how many do you work with roughly?
8-figure businesses?
Yeah.
I wouldn't even know the answer. Probably 40 plus.
Really? What do you think the biggest difference?
9 figures?
Yes.
9 figures as well, yeah.
No, not 10.
What do you think the biggest difference between businesses, like I'm talking about the structure of businesses, business owners, whatever it is to do with it, between 7-figure business owners and 8-figure business owners?
Team and culture. Team, culture, the problem that they're solving and how they're solving it, and also the business vehicle that they're in.
What's the vehicles most of the 8 figures or the 9-figure businesses are in?
So you've got to be solving a problem that you're either doing it quicker to a higher quality and there's a massive need for it. You've got to have supply and demand imbalance. So you've got to be able to supply to a high standard, and you've got to have a vast amount of demand for the service and for the supply that you've got. And you need to do it at a really high level, and you need to do it with a great team that can deliver that to a high standard. In terms of the specific models, I mean, any business model can get to 8 figures. It's just how easy can it get to 8 figures compared to other business models? Agencies, AI businesses, software businesses, they're all relatively easy to get to 8 figures. E-commerce, easy is probably the wrong word, but a lot less friction than, let's say, you know, a business where you're trading time for money. Yeah. That's a tough business to scale.
What percentage of your clients that are doing 8 or 9 figures would you say it's their first business?
I wouldn't know the answer, but I would say that majority of them have done some form of side hustle or something before, realised it either wasn't the one that's going to get them to where they want to be, or failed it and started again, and I've gone through a few iterations. I feel like once you've built a business, you built a team, you've served customers, you've made profits, you've made mistakes, the learnings that you take from that can be extracted, and if you was to then go again, you do it in 1/10 of the time, a lot more efficient, you make more money, you set it up better, you don't make the same mistakes with recruitment, you target a problem that you know there's a big demand for and there's a big total addressable market for, you do it a lot easier. So if you can extract all of the learnings out of the first and then go again in the second is usually going to do better.
I heard a statistic. Sorry, Joe. I heard a statistic. The average founder is in his 40s. I think they said 44 is the average age of a founder. So with the higher echelon of businesses that you manage specifically, the 8 figures and the 9 figures, what would you say the kind of average age is? Because you also see on social media, you've got these kids that are 19 driving Lambos and Ferraris, right? Claiming to have this. But what do you see from actually being on the front line? So because I'm a younger professional than most in the accountancy industry, I typically attract a younger demographic. Makes sense.
Not always, that's not a steadfast rule, but our founders are anywhere from 20 up to 35. That's like the typical age bracket. But we've got numerous business owners, founders, entrepreneurs that are doing millions a month, never mind a year, that are sub 30 years old, early 20s, because they've found a need, they've filled the need, they've scaled it, they've done it in a way, leveraging social media, AI, technology, etc. But I'd say for us, it's average is probably early 30s, mid 30s. That's 8 figures and onwards.
Okay, yeah. I think you also see as well, you get a lot of like people in their early 20s. They are really good at making money. They make fast money in a business, but they don't necessarily have the experience or the literacy financially to manage that. And you hear about a lot of businesses that sometimes do perhaps go under. Like how important would you say it is to actually learn the basics of money management when you start a business? And how common do you think it is that someone in their early 20s hits a nice kind of pump in a company and then kind of messes it up?
Yeah, so if you're making money, you've got to know how to keep it and preserve it, and also allocate it in a way where you're going to get the best return. So we work with clients on what's called the buckets method, which is surplus capital, which is profits. You allocate some aside for taxes, drawings, and then you focus on the highest priority buckets that are going to get you the best return. First bucket for me is always going to be the business, because that's what's earned the money in the first place. So there's elements of your business, marketing team, people, software, processes, systems that you can invest in and get a return. Always reinvest in the business first. Once you've reinvested into the business and your return starts to demise from there, then it's looking at what investments that suit your skill set. So a lot of people, service-based business, they start doing well, they get a bit of money, and then they go in property. They don't know anything about property. They've got to learn it again. They don't have any contacts. Not a smart move, if you ask me. I would prefer that you go and invest in businesses, because you understand business. You understand how to read a pitch deck. You understand how to read the financials. Use HMRC's back schemes, EIS or SEIS. And then if you want to go for something more passive, then it's setting up a holdco structure, having what's called a corporate investment account, investing in the stock market, investing in maybe a cryptocurrency if your asset sort of allocation is low enough. I wouldn't put too much in cryptocurrency, depending on your risk profile and time horizon. But yeah, use the buckets method. How we're going to get the best return, fill up each bucket in order, and then get the best return on your capital that you can.
So Josh, final question of the podcast. What's your goal? What's your long-term vision?
My goal is to continually build something that I'm proud of, with a great team that are all on a mission to serve entrepreneurs, help them save tax, help them build profitable and scalable businesses, and do it in a way where they don't have to dread conversation with an advisor or a professional or suit and tie professional accountant that doesn't understand them or their business. We found a way to serve entrepreneurs in a way where they feel like the relationship is a net positive to them and the business, and we can actually help them get to whatever them goals are. And it's continuing to do that while building a great company culture, providing it's almost like a value ladder, free content on social media to millions and millions. Then there's different levels of services that can apply to businesses at every stage of their cycle, right from start up, right to exit. And we want to support as many entrepreneurs as we can through that whole cycle.
What number would you exit the business at?
That's a secret.
Is that the plan?
Plan eventually to exit?
No plan as of now. No plan as of now. Just keep doing what I'm doing, keep building something great. And in the future, I mean, things change all of the time, right? Like what we want in life, where we're going to be, who we spend time with, landscape of business, opportunities arise. So see where life takes me.
If I'm listening to the pod now, so like who should be reaching out to you for help?
So I would say that anyone who has got traction in a business and has started to pay tax and it's started to become a pain point for them, that's when we can usually start to help. If you're not quite at that stage yet, then I would say listen to my content, short form and long form, and take that to a accountant that probably isn't going to charge you too much in line with where you're currently at in business. Our fees are naturally going to be higher, so you need to be at a stage where it warrants the right professional, and we can save you enough so that your investment into us isn't going to be a cost. It's going to be something that we can save you a surplus on. And that's usually 300, 400, 500k in revenue and above.
And speaking of finding your content, how can people find you on social media? What are your tags?
So joshthomas.accountant is Instagram. We have YouTube now, which you'll be able to find if you just, again, type in Josh Thomas Accountant. We also have a newsletter called the Tax Saving Club, and we have TikTok. We have almost every platform you can imagine. So search, find, follow, enjoy.
Thank
Appreciate
you so
you
much
coming on,
mate.
Josh.
It's been a pleasure.
Thank you for having me. Appreciate it.
Thank you.
Cheers.
Thank you very much.
Yeah, mate, that was really good, man. Thank you.